So John K asked a question: what is liquidity grab? Let's start by giving this analogy. Have you ever entered a trade and you have your position, let's say you're going for a buy position and your stop loss is right somewhere around this area, your target is right above this area. Then after doing your technical analysis, you have done everything, you have entered trade or you have opened a position right here, but right when price starts going in your direction, all of a sudden there is an impulse swing that took out your stop loss and then price starts going in your direction. Or likewise, if you're taking a sell position where you have your order around this area, you have your stop loss right around this level, and then your take profit target is somewhere around here. Then once price starts going in your direction, you are stopped out and then price goes in the direction of your prediction. What happened here is what we call a liquidity grab. What happened at this area is what we call a liquidity grab, and this is simply a manipulation that comes as a result of the smart money trying to get as much order as they can get before they take price to another direction. Now let me explain what liquidity simply means to you in one word. Liquidity simply means money. So whenever you hear the word liquidity grab, just know that it is money grab. This is smart money trying to grab your money. The banks, the institutions that have large funds coming into trade, they grab as much order as they can before they push price to another direction. Let me show you how that happens on a chart. If you see this chart now, you can literally see this happening time and time again. I'm going to literally show you how to see this on your chart and how you can possibly stay away from that. Now, whenever smart money is coming to the market to trade, you're going to find them having their footprints in the market such as this. Now, let's talk about where we can possibly find liquidity residing in a typical market. Liquidity resides below an old high or an old low. If we have a market like this and you're seeing something like this, okay, if you have something like this, at this area is where we can find liquidity. That is money, is where we can find money residing. This level has money, this level has money, and then this level has money. We can find them in an old high or an old low. This area has money residing there, okay? Then this area also has money residing. So these areas is where we can find liquidity. Is called liquidity pool. And what happens is that whenever you are taking a trade, let's assume you are buying from this area, you're buying from this level. Where do you think you're going to put your stop loss? Right below here, okay? And your stop loss is simply money. Your stop losses are what this smart money are looking for. And if smart money is going into market with, let's assume $1 billion to trade, okay, they're going to need enough order to fill in this $1 billion. If they are taking a buy from this area, they want to have enough sellers to be able to buy and fill in all the $1 billion for them. So what happens is that at this level, you that is buying from here and then your stop loss is right below around this area, you are actually saying that if price should come here, you want to sell. Your stop loss in a buy order, it is simply a sell order. Okay, so when price comes to this level and trigger your stop loss, you have simply sold your order. You have simply sold that order. So this is why smart money will have to push and buy from you that have a cheaper rate. Imagine buying at this level and at this area, this level. Buying here is cheaper than buying here. That is why they come to get it at a cheaper price from you before they push price to another level. So if they are buying at a cheaper price at this level and all the stop losses that are here, they are just like a liquidity pool, okay? We call it a liquidity pool. All this place is filled with stop losses of thousands and millions of retail traders. So if they are coming down to this level, they are simply coming to grab money before they push price to the upside, because your stop losses are sell orders. So they trigger your stop losses just to buy from you at a cheaper price and then they sell it at a higher price. So let's go to the chart and see where we can literally see this. Now we have this chart right here, okay? Normally when you want to take trade, you want to see this kind of thing happen. Your buy order is right here and then you have a stop loss right at this area. Then your take profit is somewhere around this level. Imagine what happens if you have your trade like this and then you see market starts going in your direction, but all of a sudden you got stopped out. This is what happened. You got stopped out at this level, then price moves in your direction. This is what happens most of the time, because it is not only you that has stop loss here. There are hundreds and thousands of people that have stop losses here, and anytime smart money wants to grab that liquidity, they come around here to buy at a cheaper price and they take it up to sell at a higher price. Okay, if you take this to this area, you can see these are where we can find them. Remember, I said liquidity resides above an old high and an old low. Okay, you can see this area, this level. You can see what is happening at that area. Above here, there was a liquidity grab at this area before price starts coming down. This area, there was a liquidity grab before price starts coming to that area. You can see this time and time and time again on a chart. Okay, this area, we have liquidity grab at this area. There was a liquidity grab because this place we have liquidity residing below this level, and there was a liquidity grab at this area. This was a liquidity grab. Okay, this can be seen time and time again. You can see this